Let me ask you something. How do you think a trader loses over £800 million from their trading? Now, your first response might be that, well, if they're dealing in big figures, then maybe £800 million is just, a normal sized loss for them. But I mean, £800 million is £800 million. That's a huge loss for anyone. Your next response might be, well, if they're managing that sort of money, it must mean that they're a professional trader in order to have that sort of responsibility. So surely their mistakes must not be the same kind of things that you see from amateur traders, part-time traders. But the funny thing is, in this case, the case we're about to talk about, the same mistakes that they made are the same exact mistakes that I'm hearing other people making that leads to them burning out their accounts, burning through their life savings, and just generally losing more from their trading than they ought to be. So in this video, I wanted to focus on this particular case study because even though the amounts of money are amounts that we can't relate to, the mistakes and the reactions and the responses and the psychological issues are definitely things that a lot of us can relate to. And by seeing it on such a blown out of proportion scale, then you might be able to realize the mistakes you're making and the difficult path it can lead you down. So some of you may have already guessed if you've heard about this before, or some of you may have seen our story on Instagram, the link down below in the description box, by the way. But of course, we're talking about the story of Nick Leeson, the famous rogue trader. He had a film made about him starring Ewan McGregor. He wrote a book. He's very famous for being the man that took down Barings Bank, which at the time I believe was the second oldest bank in the world.
Like many in the 1980s, Nick Leeson wanted to be rich and successful. But Nick Leeson was also a very strange man. He had an extraordinary ability to manipulate and deceive those around him. This is his story. It is also the story of those he deceived. They willingly entered into a dream he wove, lured by the prospect of vast sums of money, and together they lost £830 million.
So that clip you've just seen, and I hope it did make you laugh when they called him a very strange man, because it made me laugh. That's from a documentary that was out, I think, back in 1995 or something like that. And this documentary features an interview with Nick Leeson from when he was actually in prison. I think it was just shortly after everything happened. I believe the shit hit the fan, so to speak, in 1994. So I wanted to take parts from this documentary and watch it together because I think hearing it from the horse's mouth, someone that's been through this on a big scale, will help us pick up on the lessons that you can then take on board for your own trading. Because I think, a lot of the time people think professional traders don't make these mistakes, they don't do this, they don't do that. And a lot of the time it's because there are certain risk controls in place in financial institutions that stop them from making these errors. But a lot of these errors just come down to human psychology and something that's within us that sometimes can come to the surface and completely sabotage everything we're doing with our trading. So in this case, he got around a lot of the risk controls and he was very deceptive and manipulative. And that's how he was able to keep on increasing these losses that he had and eventually take down the bank. But I think that there's the psychological parts and the explanation for how things escalated that we can really take on board. So let's watch it together. Let's go and check out the first clip.
I mean, it was a massive loss, but and the margin payments were increasing. The market was going against me on a daily basis, and something had to be done about it. And the loss was just accelerating. It starts to get pretty frightening. I'm not sleeping at night.
But Leeson decided to go on. He took the classic gambler's strategy. He doubled up. Secretly, he bought hundreds more futures. It was incredibly dangerous and against all the bank's rules. But it meant that if the market did move his way, he would make a great deal of money and wipe out his losses.
Why did I choose to go on? What is the option to choosing to go on and to deciding to go on? You have to realise the loss. I didn't want to cause Barings to lose all this money, so I'm operating in the belief that I can get it back.
So in that clip you've just seen, what he's referring to is that he starts to build up the initial loss and it went beyond what it should have done and it was worth a few million, I believe, at that time. And obviously back then, a few million was worth a lot more than it is now. So you can imagine the amount of money that he's in loss by that point. So rather than drawing attention to the fact there's been a loss and realizing that loss, he decided that he's going to double down and try and fix the situation. Suddenly he's not wanting to admit something, he's got this loss aversion, he's not willing to accept the reality of the situation, and he wants to prolong the situation and see if he can beat it. And that's what I see a lot of traders doing. I think we can all relate to that. A loss that you take is bigger than you had initially anticipated it to be, or you initially wanted it to be. Maybe your stop loss didn't get triggered. Maybe you didn't put one in the first place. And suddenly this loss is maybe a couple of times bigger than you wanted it to be. And you think, what shall I do? Well, maybe I'll just stay in and see if it's going to come back to, what it should have been, and I'll close it then. Or some people choose the martingale strategy, which I've said is a bad strategy from the start, and you heard it mentioned in the clip, and they'll double down because they think, I'm going to have a lower average price and that's going to be better for me. So let's check out what happened next.
Then suddenly, in the spring of 1993, the market did move his way. Day by day, he made hundreds of thousands of pounds. And in July, he wiped out his losses.
Success, I was elated. I was happy. The nightmare was over.
So for him, he says the nightmare was over. All of those sleepless nights, this loss that had escalated, almost out of control, he took some action, some decisive action, had more at risk, because to combat this loss, his idea was to take more risk, as most people do when they're first learning to trade, and he got back to break even. The nightmare was over, things were good.
And Nick just said that he'd been under a lot of pressure at work and that he'd lost money, and that but now, he'd recouped the losses and everything was okay. And then I said, well, how much did you lose? And Nick said £1 million. But then reading the book, I find out it was 6 million. I mean, £1 million was terrible. I thought, oh, Nick, think about us in the future rather than protecting them.
And don't do it again.
And on the Monday, he did it again, by all accounts.
So if you didn't pick that up at the end, she said on Monday, he did it again by all accounts, which means that he got back to break even. This nightmare was over. And like she said in that clip, because she's his wife, or she was his wife at the time, she was saying, think about us next time. And I think this is the problem, that people are thinking about other people and they don't want to let people down and be a failure. And they're thinking about what they can achieve if these trades work out. So Monday, he goes and starts doing it again.
Why do you think he did that?
Because I don't think he wanted to be seen as a failure. I suppose, like I said, everyone wants to be seen as a success. I suppose he thought, well, I've done it before and it worked out okay, maybe I can do it again. I don't know why he did it.
And that's the critical thing here. When you start risking too much, then after a certain point, when you keep getting out scot-free from doubling up, you think, you know what, this works, I can do it again and get out of it. I can maybe do it again to make more money. It's the survivorship bias, and we've talked about that before in a video about probabilities. I'll put the link to that in the description box, and I titled it as one of our most important videos of all time, or something like that, because it really is one of the most important lessons in trading. But you see this happen all the time. It even happened to one of our course members who opened up on the forum and explained about it, how, they went against advice where they're doubling up all the time and increasing their position sizes, and they get away with it and get away with it, and every time they get back to break even, they think, wow, that situation's over, you don't want to do that again, until the next time they think, well, it worked last time, I'll do it again. It's the survivorship bias, and eventually, in any of these situations, when you mix up the probability of something happening with the actual outcome, or even if you just don't consider the odds at all, then eventually it catches up and bites you in the arse.
You just lived through 9 months of what you described as a nightmare. And here you are, starting to do it again.
I'm not a psychologist, I can't explain it. But, yeah, I didn't want to let the people down.
Throughout the end of 1993, chaotic world events had pushed the market against Leeson. He had tried to double up, but this time it hadn't worked. He was now at the mercy of the market. On some days, he lost more than £1 million.
It was out of hand, The market movements that I'm allowing are increasing at the same time. Everything is increasing, my capability to accept the loss, the capability to accept a larger market movement, the capability to accept a larger position. Everything increases during the period, everything's building.
In these situations, that seems to happen. So just like I mentioned last time, where you start thinking next time you can do the same thing again. You grow accustomed to these situations. And then suddenly also, once this loss gets out of control and the loss aversion kicks in and you're not willing to close the trade, then previously, before opening the trade, you probably thought to yourself, well, maybe I want X amount of pips, I'll let it go against me that much, but beyond that, I don't think it's worth, the risk for the potential return I'm making here. But as soon as it starts going against you, your mind starts shifting, like it starts deceiving you, and you start thinking, well, maybe I can allow a bigger swing. Suddenly, on occasions when you would be out when economic news is in the market and shaking things up and there's volatility, you're suddenly staying in for those events because there's a chance it could push the market back in the direction you want it to. You're suddenly willing to make a lot more allowances that you wouldn't before. You're willing to have a bigger position size than you would have felt comfortable with, bigger market moves, more time spent trading, and eventually, like I said before, these things catch up with you.
For a few days in January, things went his way. He had thousands of futures hidden in the secret account. Provided the market kept steady, they could still make a lot of money. The effect of the Kobe earthquake on the Japanese stock market was disastrous. Immediately, the Nikkei began to plunge.
It was bad, but again, it's living to fight another day, really. I mean, what did I feel? I didn't go home and cut my wrists. I didn't go and jump out of a building, some people would do that.
Leeson decided to take one last desperate gamble. Using Baring's money, he bought thousands more futures. He was single-handedly going to try and hold the market up. If the market moved up only a few points, he made millions of pounds in seconds.
So the numbers scared me. I wasn't. I didn't really want to know what the numbers were. I was hiding from the numbers as much as possible. It was out of hand, It had just gone completely crazy. How it was continuing to go on a day-to-day basis, I just can't explain to you.
Now, that bit where he's talking about not being able to look at the numbers, like not being able to face it, I find that so relatable, and I'm sure a lot of you find that relatable as well. Because, I'm not sitting here dissecting this and giving my input as if I haven't made these mistakes before. But luckily, my mistakes haven't cost £800 million, and I'm sure yours haven't as well. In fact, I pretty much guarantee it. But I'm sure we've all made mistakes that have cost us in a way that really causes us pain. And when you're trading on these accounts, like before I really learned what I was doing properly, I was burning through accounts. And I always remember that feeling where it's make or break. You have your last desperate sort of attempt, and it's like, this is either going to recover everything or it's all over. And you don't even want to look. You're seeing the market moving, and you're like, I don't want to see the numbers. It's like watching a penalty shootout with England. But I think any time you're in these sorts of situations when your body is giving you signs that you're under pressure and stress that you shouldn't be under, once it goes beyond a tolerable amount, then you surely know you're doing something wrong. Like, trading shouldn't be this constant stress. I've spoken about it before in a video on stress. Like, you shouldn't be under this physical stress all the time. When I've been in situations where I've been under that physical stress all the time, it's when I'm trading too much. I'm not, putting things in some sort of balance that's going to help me maintain this, to make it sustainable. And if you're taking big positions that you really feel it in your gut every time you open a trade, your position sizes are too big. And so when I talk about lower position sizes, it's partly because of this loss aversion, because we all have this loss aversion. And once it's beyond a certain amount, like you heard in that first clip from Nick when he was saying about, I didn't want to crystallize this loss, I didn't want to realize it, I didn't want it to be on the account, then once you get to that certain point, then that's when things start to go out of control. And it can just be sometimes just 1% beyond what is, a normal position size, when you take it a step too far. And that's why it's best to control what you're doing and be conservative about it.
But Leeson's strategy failed. The market began to fall again. His losses were catastrophic. On one day alone, he lost £50 million. But he kept going. To do so, he needed vast margin payments from London.
So ultimately, his plan failed and he was losing huge amounts of money. And in order to offset this, to be able to continue trading, he was needing to request money from the Barings HQ in London, hundreds of millions. And this is the same when people hit margin calls and they start funding their account with more money, thinking that somehow that's going to fix things. But there's an expression that I've always remembered since someone told it to me years ago, which is that you should never throw good money after bad. If you know you're in a losing situation, don't keep throwing more money at it. Don't extend your stop loss. Just cut your losses, accept the situation as it is, and move on. I think one of the key problems with any of these type of situations is that trading's a long-term thing. It's a marathon, not a sprint, to use the old cliche. But basically, you need to think like you need to be consistent every single day, and by doing so, you're going to get to your goal eventually. It's not that you're going to make all the money now. You're not going to recover every loss. Like it shouldn't be the case that just because you lose money one day, you have to recover it before the end of the day and start chasing and revenge trading. It's a long-term venture, and I think the problems start when people misalign something that should be long-term focused and a strategy they're using which should be long-term focused, because remember, everything's about probabilities, because remember, you can have losing days within a winning system. But it's when people take that, something that's long-term, and are not aligned with their actual goals and wants. They want to be more short-term, they want things to happen instantly, they want to recover their money now, they want to make profit now, and it's this that causes the issues. Even in the case of Nick Leeson, who was a professional trader, and yes, he did some stupid things, he might have been a really bad trader, and yes, the Barings risk controls might not have been as good as they should have been, and the audits that they did might not have been as detailed and diligent as they should have been. But at the end of the day, that was a professional trader making these mistakes, and we're no different, and it's always when we have this misalignment. This is actually something I spoke about in our live event last year, and I actually used the example of Nick Leeson, it just came to my mind at the time, to explain like the misalignment. Let's just have a quick look at that. So when you're executing on behalf of a bank or something like that, you're looking at the long term. And so you can tell the times when that starts to go wrong, when a mistake is made, and to cover up the mistake, the shift goes from long term to short term. Reactionary stuff to try and make up for a short term mistake that you've made. So in this case, it caused the bankruptcy of a huge historic financial institution. I mean, forgetting the fact he tried to cover up the mistake and that kind of thing, the fact he was, it's obviously deceptive and stuff, the fact he was trying to cover up, the way he was trying to cover it up, is shifting from this long-term focus to short-term, and it caused the collapse of the oldest bank in the world. Now, for us, we don't have the luxury, if you want to call it that, of having a long-term goal that we're paid to be hitting, or paid to be staying in line with. So we have to set that ourselves, and we have to keep that in mind. But the same thing is true. When you change your focus to the short term, then, for want of a better word when I'm tired, it f***s everything up. So I hope from this video you picked up on a few bits and pieces that you can maybe relate to and try and avoid in the future. But I think the main thing is coming to terms with the fact that trading is going to take you a long time to learn how to do properly, and then it's going to take a long time after that to get to the profit that you want to be at, unless your starting capital is huge and pretty much already there. Like, you just got to think of it like, this is something I really want to do, and I'm willing to put in years to, you know, achieve my goals through doing this. And if you're not willing to do that, if you're not willing to come to terms with that and accept it, then you're likely to keep going in these cycles like Nick Leeson did, except you're never going to have the time to lose £800 million and end up in prison for a few years like he did, which will put an end to it. But anyway, guys, I'm going to leave that one there. Hope you enjoyed this slightly different format. Hit the thumbs up button if you did, if you like this video. I think we're going to do a more detailed little documentary type thing, similar to the Trading Legends videos about Nick Leeson and the collapse of Barings Bank. So look out for that one, and don't forget to subscribe to the channel and switch on notifications so you don't miss out on that video and any of the others that are coming out. I appreciate you watching. I enjoyed this one. I hope you did too. Take care, and I'll see you soon.